Okay, the topic that Alex and I am going to present is an empirical analysis of historical volatility. And this is the outline of our presentation. I want to briefly motivate why we do this. Then I describe where we got all the data from. And then I will present what we are actually estimating and what the volatility estimator is. And finally, I briefly show how I implemented it in R with two functions that I sent around yesterday afternoon. And the core topic is then the empirical analysis, where we go thoroughly through a bunch of questions. And finally, we sum up our key findings. So the motivation, you have already seen volatility in the context of Black-Scholes option pricing formula. And there we've seen higher volatility suggests higher option prices. So the thing is that we do not observe volatility, we don't know what volatility is, but we know it's one of the key parameters in the option pricing formula. So what Professor Hertel and Shimon like to do is to work with implied volatility, which you can compute from the observable option prices. What we do in our analysis, we take the observed market prices of the underlyings and compute historical volatility. So that's the difference between historical and implied volatility. And we want to find out what the true nature of volatility is for different assets, for different time to maturities, and for different markets in general. And yes, finally we want to answer the question whether the presumption in the Black-Scholes option pricing formula is correct, which says that volatility is constant. So this is the motivation, and just to give you an impression what an enrichment the FEDC database is for our analysis, let's have a look at the data we have collected. All in all, we have 134 time series, and we have stock markets under investigation, bond markets, foreign exchange rates, and some exotic underlyings. So we have the standard things as S&P 500, DAX 30, MDAX, SDAX, and just look S&P 500 when it starts. We have daily series from 1928 up to end of 2006, and it's actually pretty cool to work with such good data. Yeah, that's true. That was the first thing I was thinking about. Whereas Nikkei starts in 82, Russia, Bombay, so we have even excellent data for emerging markets. And it's just continuation of what else we have. Bond markets, Germany, government bonds, different time to maturities, up to 30 years, Japan, 2 years, up to 8 years, 10 years, 30 years, even corporate bonds for different ratings, AAA, AA, and then United States government bonds for different maturities, then United States corporate bonds, and look what excellent data these are. AAA for different maturities, AA different maturities, even burst ratings, just 1A, different maturities, and finally the BBB, also for different maturities. That's the bond market data we've analyzed. And then we did the foreign exchange market. So we have standard currencies as euro against US dollar, British pound, Japanese yen, Swiss franc, the Turkish currency, Russian ruble, Mexican pesos, Argentina, China, India, and finally some exotic underlyings, which are oil, gold, and spot. And these are all the time series we have analyzed and estimated historical volatility. And if you go to the appendix, the appendix you find all our estimations. We estimated volatility for n equals 80 days, that is the past 80 days, and we estimated volatility for the past 180 days, so 90 days and 180 days. And for all the underlyings that I have shown to you, you find in the appendix all the estimations. Okay, one slide on how our estimator looks like. And this is taken from the SFM book. First, we compute the logarithmic returns, and then we compute the mean log return, and then an unbiased estimator for the volatility, historical volatility, is the square root over the squared deviations from the mean log return. Any questions so far? Am I too fast? No?
Could you go back one more time? So, okay. That's the volatility. Yes. Why did you choose 90 days?
We choose 90 and 180 because the SFM book says this is what in practice is done. But basically,
the second part of the summary you will learn that the standard risk matrix approach is 252 days, right? 1 year.
Okay. So now we know what the theoretical estimator looks like. The next step in our analysis was to write a program function which estimated volatility. And what I did, I wrote a function which is Ebola, and this is where I declare the function. You can plug in any financial time series dot. Then you can choose what the window, how many past days you want to include in your computation, and you can give a name to the series, which will be plotted then, and n ticks means how many ticks do you want to have on your x-axis. And the code is pretty lengthy, so this is just to show you what the code actually does. And yeah, it computes, first of all, the mean log return, and then computes historical volatility, and it even plots it in a pretty nice fashion. And I wrote another function which is compare. You can plug in two financial time series, .A and .B. Then you can choose again the window, and you can give names to the series, which will be plotted too. And same as in the Ebola function, you can determine how many ticks you want to have on your x-axis. And we will see what this compare function does when we come to our empirical analysis, where we see all the plots of our estimation. And this is where empirical analysis starts, and yeah, Alex will continue for the next minutes.
Okay, as you see, Bjorn is pretty proud of the data you got, and let's go to the flesh and bones of our project and see what can we do with this data.
Stop doing it here.
Ah, okay. Okay, so two main questions. The project concern itself was, is historical volatility constant over time? And second of all, is historical volatility, does historical volatility vary across different underlyings? So these two questions are actually pretty easy to answer. Obviously, the historical volatility is not constant at any time, whatever underlying you take. And if you take different underlyings, it will be obvious that the nature and shades of volatility can vary a lot. For example, if you take this is an Nikkei, which is the most volatile out of broad indices, and this is exchange rate of Russian ruble against the United States dollar. So it's pretty obvious that historical volatility is not constant in time, and it varies across different underlyings. However, in order to entertain you during the last other 10 minutes of our presentations, we decided to look somewhere in details. What interesting can we see in stock volatilities, in bond volatilities, currencies, and some exotic underlyings. So So the first thing worth of noting is what is the difference, how graphs looks if we have 90 days or 180. The main idea that even though 180 days volatility is more robust from statistical point of view, for graphical purposes, 90 days is more informative, because first of all, in case of one short event, 90 days volatility forgets this event faster, and 180 days sometimes smooths too much, and some information can be lost by, for example, these peaks and falls. What is also interesting to see, if you remember a presentation you saw in Deutsche Bank, in Deutsche Börse, it was mentioned there that it makes sense to do a portfolio of some stocks and volatility instruments. And based on this graph, they have returns on Nasdaq and its volatility. Making such a portfolio would be one of the clearest things to do, because when the market is going down, volatility is going up. When the market is going up significantly, it also pushes up volatility. So it's a type of hedging. The first thing to see is major broad indexes. Well, most of them move similarly, even though with different magnitudes, but most of the peaks and falls coincide. Well, the extreme example is S&P 500 and Dow Jones, whose volatilities move basically in a lockstep. Emerging markets, as any logic suggests you, are more volatile than established broad markets. Here you see Brazilian stock market and S&P 500. And emerging market indexes and established market indexes, their volatility does not very much relate. For example, Brazilian and S&P indexes, they were related in some 6-year periods from 1997 to 2003. In all other periods, Bovespa index lived life on its own. However, emerging market indexes are pretty much related to each other. They also pretty often move in lockstep. Peaks and falls coincide, with the exception of some one-time events. For example, this is Brazilian index and Argentinian. Here this chart is the
horizontal line. Yeah? What is the horizontal line?
The horizontal line is time.
No, it's a broken dashed horizontal line.
Okay, these are averages. So the red one is average of the Brazilian index, blue one is average of Argentinian index, and black one is an average of a difference. However, if we take some other emerging markets, like India, China, Philippines, and Turkey, we popped out. We found out that they actually live a life totally of their own. Their volatilities are not anyhow related to major indexes in general, or to other emerging markets. If we take a look at Russia, it comes up with that it also, in general, lives life of its own, with the exception of '98, when Russian crisis shoot waves of crisis around emerging markets. But what is interesting to look at is the difference between Russian stock market volatility and oil price volatility. Because most of Russian stock market capitalization are oil companies, and there is some relationship between oil price volatility and Russian news. And another finding we managed to take away out of this data, that technology stocks are more volatile than broad indexes, which is also pretty logical. And well, what was a bit surprising is that both Nasdaq and Tech DAX appear to have the same magnitudes of average volatility. And another thing which popped out, that Nikkei 225 and DAX 30 are the most volatile out of broad stock market indexes. So that's all about stocks.
And now Alex has shown you some results on the stock market. Let me briefly go back to one of the previous slides. where are we? What I'm going to do, I'm going to present some results on the bond market. And the questions I want to answer, considering the bond market, is first of all, whether historical volatility is the same for different times to maturity. This is the first question. The second question related to the bond market is how government bonds from the leading economies compare to each other. And the third question is, whether corporate bonds are more volatile than government bonds. And finally, if corporate bonds can be grouped according to their rating into different subgroups of volatility. Because one would suggest that those corporate bonds which have a very low rating, say BBB or BB, should be in principle more volatile than a corporate bond with a rating of AAA or AA. Okay, so let's consider the first question, whether historical volatility is the same for government bonds with different times to maturity. Okay, what you see here is the estimated volatility for German government bonds. This is 1 year time to maturity, 5 years, 10 years, 30 years. And if you have a look on the mean over this time period, then you might suggest that this mean is higher than this mean is again higher, and this mean is again higher. So one could think, well, maybe the shorter the time to maturity, the higher is the volatility for those government bonds. Yes? So,
I don't understand this, but to me, these plots are differently scaled, or are they all still the same?
They have the same scaling, but it starts from...
So because on the left upper corner, it doesn't have... all other has 4 numbers, but on the left upper corner, it has 3 numbers. There's different scales.
Yes, but what I want to say is that...
you have to scale them identically.
This is... Yes, that's what we could improve.
You haven't done it?
No.
And also, I don't understand why you have the mean return and volatility in the same plot.
Well, this, if you look at this mean, right, then you see it should be...
You should really have, by chance you can do it. But you should really have, say, on the left side, a scale in red corresponding to the volatility. On the right side, a scale in blue corresponding to the mean if you want to have it in the same plot. So,
okay.
it would be divergent.
The next thing, okay, so let's answer this question. And what I now do is I compare the volatility of different government bonds. Here it's 1 year and 5 years, 5 years and 10 years, 10 years and 30 years. And to make things clear, I compare 1 year to 30 years. And what you can see, the difference in volatility is here nearly 0 or slightly above 0, slightly above 0, above 0, and this is slightly below, this is even much more higher than 0. So the overall presumption or the statement that volatility decreases with time to maturity is correct. So if we have investigated this question for Germany, let's do the same for the US. I compare 1 year against 5 years. 5 years, 10 years. 10 years, 20 years. And to make things clear, 1 year against 20 years. And as you can see, the difference in volatility on average is above 0, above 0, above 0, above 0. Yeah? And the same holds for Japan in principle, with one slight exception. And that's the 10 years against the 30 years, which is not clear why the overall mean for the differences is slightly below 0. This is against intuition, but it looks pretty much as if in the 2003, 2004, the 30-year bonds jumped in volatility much higher than the 10-year bonds, which is hard to explain when it's like this. Okay, the next question I did was I compared whether if there are any differences in government bonds between the leading economies, and I skipped this question. I just say that on average US government bonds are more volatile than Germany. That's an empirical finding. Then I compare corporate bonds and I ask whether corporate bonds are more volatile than government bonds, and I do this for the US. And I do it for different time to maturities. This is 2 years, 5 years, 7 years, and 10 years. And our finding is that on average, corporate bonds with AAA rating are more volatile than government bonds. And then I expected a higher difference in volatility when it comes to a corporate bond with a lower rating, namely BBB, but this doesn't fulfill. So the differences in corporate bonds, AAA rated to government bonds, is nearly the same as the difference in volatility of corporate bonds, BBB rated, and government bonds. Hard to explain, but it's what we find out. And finally, I checked the question whether corporate bonds with different ratings, namely the best AAA and the worst we could get, BBB, is significantly different. And this, again, the difference in the two volatilities. And look, this doesn't make much sense actually. For 2 years, the AAA is more volatile than the BBB. But I had a closer look on the graphs, and what you can see is actually that in the between 2003 and 2004, the corporate bonds AAA rated had a huge jump in volatility for 5 years, the same for 10 years, 7 years, and again for 10 years. But in the same time, BBB rated corporate bonds didn't jump that much. So maybe there was some company which was AAA rated and then got a much worse rating, and that's why maybe the entire market, it collapsed to the entire market, and that the entire market had a higher volatility. So I thought of maybe things like MCI WorldCom and other US companies which committed some sort of fraud in booking. Out of time. Okay. One word to the foreign exchange market. Okay. Last thing, because it's really extremely interesting. If we compare the leading economies' foreign exchange rates, we don't see much difference in these. But if we compare the emerging market economies' foreign exchange rates, we see some very interesting things. Does anybody have a clue why for the US dollar against the Argentinian currency we do not see any volatility over here?
It was dollarized, right?
Right, it's pegging. And if we want to analyze the foreign exchange market, we have to take into consideration things as pegging, corridors, dirty, floating, devaluations, for example, as in Turkey, where you see there's no volatility, they have either pegging or a corridor, and then there's a huge jump in volatility, and it just comes from devaluation. So it's really hard to get a clear view on the volatility structure in the foreign exchange market when it comes to emerging market economies, because we have those biases as devaluations and pegging and corridors in it. Yes, and that's
finally the Chinese currency, where you see they have, first of all, the corridor, then it's devaluation. They have pegged their currency to the US dollar, devaluation, devaluation, devaluation. And this is really hard to analyze or to say something substantially on the foreign exchange market when it comes to emerging market economies. Okay, now I think we're really running out of time, and I just want to finish this presentation with a question. And the question is, when it comes to exotic underlyings, oil is not very interesting to analyze, but when we analyze silver and gold, we had no answer why silver is substantially higher in volatility than gold, but maybe you have a question. Thanks for your attention.
Questions?
For the Japanese government bonds, there was a phase where the 30-year was actually more volatile. Is it possible that that was during inflation?
Yes.
And there was an inverted yield curve?
Basically, there's always some story behind it, but you can't read it between the lines, right? I mean, you see the graphs, and then you have to think, okay, what happened then? And yes, there's always a story behind it. Any other questions?
Yes, I didn't like this programming style.
Which one?
Yeah, which are okay. What I didn't like is that you call it Ebola. Name, maybe it's rather Kalkbola, right?
Okay.
Or
I'm a lazy guy and I wanted something very
and
short.
then the other function was called compare. This is particularly dangerous in skillful programming. And you call a function that just plots two time series in a one blue and the other one red. You wouldn't call it compare, because compare is a much too general name. It is a source of future errors. In the compare, I didn't like, yeah, it's here, just make control. I didn't like that you distinguish the data sets, that's fine, that I can be, no problem with that. But you are unable with this function to compare two data sets, or maybe the same data set, with two different window size. Because you fix the window size n equal to 90. So you have to stack the plots differently. Yeah?
So what do you want to have? I mean,
Yeah, you would say NA equal 90, NA and NB, two different parameters.
but then you compare apples and
But you do it also on one of your plots.
okay.
You have on the upper part you have 90, on the other part you have 180. You could do it in one plot. When you are supposed to together. So I don't see really the value of the programs. That was my basic comment to that. And then some of the functions you did not do with compare, right? Because you had 3 or 4 plots in there, so you did it by hand.
Just resetting the graphic parameters in R. There's a tiny command for it.
Yeah, sure, it's clear, but you didn't use compare for that, right?
No.
Yeah.
If we had 5 graphs in one graph, it would be messy.
I know.
So you don't like our graphs? I thought you might be proud of it.
The graphs, I didn't say, I mean, the graphs are okay, except that one of them were not scaled identically. Remember that? We have to take that. And then the programming seems to be, for the reasons that I told you, especially this compare function, it's dangerous. To give functions that have just a very special function, or they just got these 2 curves. To give it such a general name. We called it in exploring polyplot. This kind of function. We should call it times or great times plot and series plot. Okay. Any more comments? Then I missed greater than, and at some point they claim that as maturity increases, volatility decreases.
Again.
As maturity increases,
Yes.
volatility decreases. You make this clear, yes?
I mean, this is just eyeball econometrics, right? I mean,
Yeah, sure, but I'm a scientist, not just eyeball. Okay? So could you formulate this in some kind of hypothesis that you could test?
I mean, I have some intuition for that, but
Well, if you think of the yield curve, right? The yield curve, you know what that is. So you're talking about the volatility of the yield curve, essentially.
Yeah.
Yes. So when you have a yield curve, you mentioned that you can have inverse,
or normal.
or you have a normal, right? And so what you disclaimed that you had was that the volatility decreases. It means it's a monotone decreasing function over tau, yeah, or time inequality. So it would be interesting to make a test on monotonicity to support your eyeball economics. So,
Well, it's possible to check it at separate points, but then you need to somehow plug in gaps.
but you could start with the general overall volatility that you have calculated. If this was your vertical bar as a horizontal bar. So you have 7 horizontal bars, and we would like to check whether that's really a monotone because you have some calculations. Yeah, estimators. It's possible to test monotonicity actually. Some tests for that. Anyway, let's go to the next